I want to welcome you back for the final segment of the contributed capital. On this one, we're going to look at key executives getting compensation, stock compensation for performance-based activities. So we have key executives will receive 100,000 shares if sales increase by 20% after 4 years. The option has a fair value of $8. So the first one we're going to do is assume that it's probable. So we would do just like we did before, the 100,000 times the $8 value for the options gives you 800,000. So this will give us then the compensation expense. And if you want, we can take the equal 800,000 divided by 4, or 200,000 a year. And this is going to be the additional paid in capital, just like we had before, stock options, and that will also equal 200,000. Okay, again, that's a credit, so we'll move that over. Okay, that's in 2013. And in 2014, we're going to do the same thing because we still think it's possible. So it's 200,000. Okay. And then probability goes to 0. So in other words, what happens is something happens, you say, it's not going to happen. Okay? So then we do it additional paid in capital, stock options. We've put 2 years in there, so we take out the 400,000, and then we credit compensation expense. $400,000. Okay, because we think it's not going to happen. It's not going to increase by 20%. Maybe the sales have actually gone down the last 2 years. Okay. Same example, except it's going to be reversed. The first 2 years, we don't think it's possible. Then by the end of 2015, say, you know what? They're at 20% already, or maybe they're at 18%. It's likely to happen. Well, this is just the opposite then. The first 2 years is no entry because we don't think it's going to happen. And then here we do the compensation expense. To bring it up to date, we would need 600,000. And then additional paid in capital for stock options is 600,000. Because remember, it's 200,000 a year, and this is for 2015, so you have 13, 14, and 15 to record, so that's the 600,000. And then here we'd have the compensation expense. For the normal 200,000 and additional paid in capital, stock options for the 200,000. And then these are both credits, so let's get them to look like credits. Oops, one too many. And this is a credit. Okay. Now if they did this, you would go back to this other one we did up here, and it actually be recorded the same way, where you debit like we did earlier. You had debits of the cash for whatever the compensation was for, and then you would have because we didn't give you what those prices were that they could actually buy the stock for, but you do it the same way. You debit cash, credit common stock, or debit APEC stock options, and then credit common stock and APEC common stock, just like we did before. Okay, well, that's stock options, and that should take care of that one. And this is the end of that chapter. That's contributed capital.